Obviously, I spoke about the elephant in the coal mine, which is inflation. It's very clear that most pundits in India have already reconciled to the fact that we are now cooling off. And the data also shows that on a month-on-month basis when you start looking at things. So yes, we are cooling off from an inflationary trend perspective, but it's also important to zoom out and study certain trends that is happening from a structural perspective. Now, offshoring of supply chain is a real trend that is going on. As many of you are aware, iPhone 14 production, a significant volume has actually come from India. It's actually come from this state that we very well sit in at ITIS, just Tamil Nadu. We visited that plant and I understand at close quarters how that plant as well as the supply chain is operating. Now, currently, no matter what people say, the supply cost of producing an iPhone in India is still higher than in China. Now, obviously, it could change over the decade because of volumes picking up. But if you start looking at iPhone 14 costs, you will see that in the price. US and Europe have taken their debt levels to around 250% of GDP in the last decade. Now, the implications of this is the economy must grow and the governments have to fuel this. Debt to GDP is no big deal, to be honest, in terms of fueling it at a government level. Why is that? Because you can fund that through growth. How would they have to fund that? They could only fund it through higher inflation. Because if you think about it, you have to increase nominal growth. In order to increase nominal growth, you have two levers to play around with. You have real growth and you have inflation. So if you have to increase my nominal growth, I will have to fund my real growth and I have to fund inflation. So this is not me talking about it since time immemorial in the last 70 years. The proven way of getting out of high level of debt is to actually grow aggressively. And in order to actually grow aggressively, governments do that by actually giving government guarantees. And that's what you're already seeing today. So it is our strong belief that the Western countries, because of the high level of debt to GDP, which in itself is not a cause of concern, will fund their future growth through capex additions. And this will continue to be inflationary in nature. So while you talk about short-term trends of transportation costs coming down and raw material prices coming down, which will cool off things on a month-on-month basis, structurally, if you zoom out over the next 3, 5, 7 years, you are entering into a regime of high inflation. What that means is you want to be owning businesses. So I spoke to you about B2B manufacturing, and I'll link this B2B manufacturing team that we own around why this matters to us. So it's important to understand that while inflation per se is not bad, there are certain ramifications and second order effects of this, which people need to zoom out and realize. And this does not mean that interest rates will go up, and as a result of which we need to be cautious. All this means is the kind of companies that you invest matters a lot.